All right, so today we're going to be looking at Chapter 7 of our managerial accounting text, and that is dealing with budgeting strategy. So now this video is actually going to be a series of 9 videos because there are 9 different sections in this chapter. All right, so first of all, let me read a little scenario to you. So making it real to you, and you'll find out kind of why. This actually is a picture behind me of Merced College. Um, so this is Merced College behind me, and this actually is over by what they call the IAC building. It actually no longer is pink. They repainted everything, so now it's gray now. But it looks the same like this. And actually, our Rising Scholars office is actually in one of those buildings as well. But you'll see why we're on the college campus. So imagine that you're a college student that is living away from home for the first time. Many exciting things are happening in your life right now, including classes, new friends, and maybe an interesting part-time job. As you are distracted by new things, it's easy to overlook the significance of budgeting. After all, you have so many positive things to focus on and worrying that money seems unimportant. Budgeting, however, is one of the most crucial things you can do as a college student. You may rely on financial aid or a part-time job. In either case, you need to be aware of where your money is going and how much you have to spend. Budgeting will help you make wise financial decisions, such as whether you can afford to go out to dinner with your friends or whether you need to save up for a major expense. You can get ready for the future by creating a budget. You can minimize the stress of not having enough money to pay your bills by saving for emergencies or unforeseen needs. Developing the budgeting habit now can also prepare you for future financial success. So if you are a college student, spend some time considering your spending plan and how to maximize your funds. You may achieve financial stability quickly with a little thought and effort. And so this again kind of brings it down. So they're going to start out applying this in kind of a personal way, and then you'll see how this will be applied in a business sense, how this would help us. Okay, so chapter 7, budgeting strategies. And first of all, we're going to identify the benefits of budgeting. So an introduction to budgets. And so again, forecasts and budgets, they both are tools that act as a map of the future to help managers to plan and to make decisions for a business. And we know that a budget is going to be focused upon a longer period. So either from a month to 5 years is what we would budget out for. And a budget is going to be expressed in monetary terms. Now, a forecast is usually a shorter term prediction. It could be one working shift to 1 month. It can be expressed in monetary terms or non-monetary terms, and it may focus on one thing. Could be the number of items that are going to be produced or advertising costs. Those are all things that could be part of a forecast. So again, kind of to bring this now, like the story that I read, kind of bring this to a personal perspective. We see that before preparing company's budget, we're going to look at a personal example. And so in April, student Hilga Linderson is planning her budget for the month of May. And so she earns $3,000 in salary during the month of May. Her student loan payment, which is the principal only, is $1,000. And then the interest on that is $50 a month. She's working on that. Her rent for a shared apartment, her portion of the rent is $600. Hilga estimates her living expenses to be $1,100. And then she also knows that her car is going to need new tires in May, and it's going to cost her approximately $500. So she's prepared then what is known as a cash budget, which shows the cash receipts and the cash payments that she is expecting to have to make during the month of May. So we see here her inflow, which is her salary of 3,000, and then she has rent of 500. She has her excuse me, 600. She has other living expenses of 1,100. Her tires that she's going to have to pay out of 500. Her interest of 50 on her, and then her loan payment of 1,000. So she actually is going to have cash outflow of 3,250. So she actually has a budgeted outflow, negative cash flow of 250. So she's going to have to cut somewhere, or she's going to have to make a decision on what she's going to do. So knowing that she's going to have a negative cash flow of 250, Hilga is going to have to make a change to her plans now in order to ensure that she's going to have enough cash to get her through the month of May. So what she could do is she could decide that if it's safe for her to do so, she could put off buying her tires until June, right? Or if she has to buy them in May, then she would have to reduce her living expenses by 250 in order to meet it. So maybe she's got in there that she's going to want to go to the movies, or she's going to want to take a trip, or go out to eat during the month of May. Well, she's going to have to cut back on that so she has that 250 available if it really is critical that she has to buy these new tires. And so preparing a cash budget, it allows us to better manage our cash funds and to see exactly, what's coming in, what's going out, and what we have to do. Now, if instead of a cash budget, Hilga could also create what's called a budgeted income statement. And this is something that a lot of businesses will do. Now, the two documents, they would be the exact same, except the $1,000 student loan repayment is not an expense, but it's a liability. Because it's possible that she doesn't have to pay it now, that she would have to pay it in the future. Normally, here in the United States, you don't have to make payments on student loans until you've graduated. It could be different where the author is, because the book is published in Canada, so their laws might be different. I'm not sure. So anyway, as a result, Hilga's budget income statement could show a net income of 750. And this example shows that the cash basis cash budget, which is a $250 shortfall, can give a different result than the accrual-based budgeted income statement, which is 750 net income. Changes in cash don't always reflect accrual-based net income or net loss, so it could be different. Budgeting, using a budget. So the accuracy of a budget is going to be largely dependent upon the assumptions that are being made. And so if Hilga's assumptions are different than the actual results, what she actually ends up spending, then the end result could be a more difficult financial position than is anticipated. So what we want to do when we're creating a budget, it's important that we create a budget that is as accurate as possible in order to be able to make the best decisions. Now, one of the other things that businesses that they must do is they must do planning and controlling activities. And so one thing that most businesses will do, they will create what is called a strategic plan, which is a roadmap for the business. And it's going to be guided by the mission and the vision of that particular company. And for-profit businesses will often do this. Nonprofit businesses will often do this. And so even like a place like Merced College, they will create a strategic plan. And they may actually have multiple strategic plans, based upon the different areas and what goals and what things they're working toward to do. And so what this does is this helps to lead to the creation of goals and objectives that help to chart the future of the company. And a full strategic plan might include a marketing plan, a human resources plan, a capital plan, finance plan, etc. Now, budgets are incorporate all of the financial aspects of the strategic plan, and they are integral in helping companies to reach their long-term and their short-term objectives. And so we see this chart on slide 10. It's also available for us in the text on page 227. So we see how budgets are created as part of this planning and controlling process. So again, we develop the strategic plan, we set up our long-term, short-term objectives, then we budget, we plan, and we do a long-term budget, short-term budget, and then we have our actual results, which are then calculated, during that budget period, what actually occurred. And then we go back and we always will control and we always will compare our actual results to budget to evaluate performance. And if we need to, go ahead and revise our strategy and then improve our budgeting process for the next time. So long-term budgets, they set up objectives that involve broad planning and will impact the entire organization. And this type of planning usually will look about 3 to 7 years into the future. So companies will do this. They'll kind of plan out, particularly if we're doing a strategic plan, we'll look, about 3 to 7 years out, kind of budget where we think things might be at that point. Obviously, we don't know, for certain because anything can happen that might change what those plans are. We might want to be offering a new product or service at that time that we didn't anticipate, or we might have something happen, not to bring it up again, but like the COVID pandemic, that we weren't expecting that to happen, but it can happen, and that changes what might happen in the future. But still, it's good to do the best we can to plan and to look to the future and what we think might happen. And so strategies are developed, and they could include things like selling or closing a location of the business. That'll happen, and we would set plans to do that, maybe to launch a new product line or to go into a new geographic area. And we see that a lot of businesses, they will set up these goals and then they will do that. So long-term budgets, they are created in order to align with these long-term objectives and strategies and help the business to be able to plan. And given the long time frame, a long-term budget will likely be changed as circumstances change, but this just gives us kind of a starting point. Now, short-term budgets are used to help us to plan for short-term objectives that involve planning and operations of the company to meet a long-term strategy. Budgets that are created for the short-term objectives usually cover a period of a year or less. And this is something we're normally working on. We do have our long-term budgets, but we also have, yearly budgets or quarterly budgets, that we're working toward. And these budgets are usually much more detailed than long-term budgets, and the revenue and expenses are all planned with as much detail as possible. Now, short-term budgets become the plan for the year, and to properly control the company, managers would compare the actual results with the budget. And then planning and controlling ensures that the budgeting system is a valuable tool. So again, some of the different benefits of budgeting are going to be that budgets are going to be used to help to plan a company in order to help them to achieve their goals. Managers from all areas of the company are going to contribute their area's revenues and expenses when the budget gets created. This improves the acceptance of the company's overall budget goals, also encourages communication among the different managers, and also when creating a budget, managers have to consider alternative courses of action in order to achieve the strategic goals. They assess each alternative for its impact on revenues and expenses in their own and also in other departments. And managers become aware of their impact on the company as a whole. And so everyone must understand the past, but also look forward when they are doing budgeting. So you're understanding what happened previous and then where things are headed going into the future. Budgeting requires managers to consider internal and external factors and to assess alternatives. And again, some of our external factors would be our general business conditions and the rate of inflation. We know that's something we have to be on the lookout for, is kind of how is business going? Is business booming? Is it contracting? and also obviously how inflation is going to impact. Also, local competition. Do we have a new competitor coming in? How is that going to affect? And then also local labor skills and availability. And we use budgets for control. We want to compare the original budget and the actual budget in order to improve operations, to assess management performance, and to improve budget creation into the future. And then also looking at the time and cost of doing budgeting. We know that all the advantages of budgeting also have to be balanced with the fact of the time and the cost that it goes into preparing budgets. Typically, the larger the company is, the greater the time and the cost that's involved in preparing these budgets. And so planning and controlling a budget are going to be key to keeping a company on track in order to remain in business and to remain profitable. Budgeting is a key function of management accounting. So we see that which of the following is true? Is it that budgets that are created for short-term objectives typically cover a period of more than a year? Is it that budgets can be expressed in both monetary and non-monetary terms? Is it that the advantages of budgeting have to be balanced against the time and cost that are used to create budgets? Or is it that the budget is a roadmap for a business that is guided by the mission and the vision of the company? And it is that the correct answer that's true is that the advantages of budgeting have to be balanced against the time and cost to create budgets. But it is an important activity that we do. Now, which of the following is not a benefit of budgeting? So is it that budgets encourage managers to communicate with each other? We said that before, that's true, that budgets, when we're creating them, it does help all the managers to come to the table and be able to do that. Creating budgets can be costly, that's true, but that's not a benefit. But budgets can be used to improve operations. We know that is true. We also know that budgets require managers to consider internal and external factors, and we know that is true. So we know that A, C, and D are true, so B is not a benefit. Now, which of the following statements of these is true? Is it that a short-term budget will likely be changed as circumstances change? Is it that a possible outcome of the planning process is evaluating management performance? Is it that a possible outcome of the control process is improving the budgeting process, or that budgets that are created for long-term objectives typically cover a year or less? And what's true out of that is C, is a possible outcome of the control process is improving the budgeting process. So short-term budgets, they're not going to be changing as frequently. They're not going to be changed. Longer term, they might be. We wouldn't use the budget to evaluate management performance, but we would use, we would go back and evaluate that, and that may be an input there. So anyway, so it is C is the correct answer there.